The bond market got a piece of good news today. Oil prices dropped, rates improved, and then almost as fast as it started, most of those gains disappeared. That's the story of this market right now, and understanding why it keeps happening is the single most useful thing you can take into your next client conversation. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Welcome to this week's weekend update. Let's get into it. This week's mortgage rates. Before we cover the week, here is where rates stand today. According to Mortgage News Daily, the 30-year fixed is at 6.44%. The 30-year VA loan is at 5.94%, and the 30-year FHA is at 5.92%. These are national averages for Mortgage News Daily and are not an offer to lend. The 10-year Treasury, which is still trading as we record this, is sitting at 4.37% compared to 4.3% last week. That is a move in the wrong direction, and the reason that matters is this. Until the 10-year finds a reason to move convincingly lower and hold, mortgage rates are not going anywhere meaningful. Technical signals suggest the range right now is roughly 4 to 4.5%, with the path of least resistance still pointing higher. The oil rate connection, again, this week told the same story it has been telling for months, just with a few new plot twists. Wednesday brought a spike in oil prices and rates followed higher. Then overnight, Thursday into Friday, reports surfaced that Iran had sent new peace proposals through Pakistan. Proposals that apparently offer more concessions on nuclear aspirations. Oil dropped, bonds rallied, rates improved. And then by midday Friday, much of the improvement had faded. Why? Because the news was thin. The market had gotten a little ahead of itself, reacting to headlines that did not yet confirm any real progress. So what we had was a classic whipsaw, a sharp move that reversed almost as quickly as it began. This matters for every professional in this room because your clients are watching rates on their phones. They see a headline saying rates improved. They get excited. And then by the time they call you, the moment is already passed. Your job right now is to help them understand that this market moves on geopolitical headlines, not just economic data. The Strait of Hormuz situation continues to drive energy prices, and energy prices are driving bond yields. That is the chain. Peace talks continue. Their outcome will matter. What the economic data said this week? Beyond oil, there was a full week of economic data, and it painted a picture that is worth walking through carefully. The Federal Reserve held rates steady on Wednesday, which was expected. What was not expected, or at least not common, was 4 dissents at a single meeting. That has not happened in 34 years. 3 of those dissents came from members who were not pushing for a cut. They objected to language in the Fed statement that they felt carried too much of an easing bias going forward. That kind of internal disagreements is worth noting. It tells you the Fed itself is not of one mind about where policy goes from here. We also got the PCE report, the Fed's preferred inflation measure. Headline PCE rose to 3.5% year over year, up from 2.8% the prior reading. Core PCE came in at 3.2%. These are not numbers that give the Fed room to cut. A big driver was energy, specifically higher gasoline prices that worked their way through the entire inflation picture. First quarter GDP came in at 2%, below the 2.3% forecast. Consumer spending rose 1.6%. Personal income increased 0.6% in March, double the estimate. But spending rose 0.9%. People are spending more than they are earning. And because of that, the savings rate slipped from 3.9% to 3.6%. Now, here is the part that does not get as much attention, but should. About 40% of that spending increase in March came from higher gasoline prices. When you strip out inflation and look at real spending, the actual increase was about 0.2%. The consumer is not going on a shopping sprees. The consumer is paying more for the same thing and drawing down savings to do it. Manufacturing data added to the picture. The ISM Manufacturing Index held at 52.7 for April, which is technically in expansion territory, but the ISM prices paid component jumped to 84.6, well above the prior reading of 78.3 and above the forecast of 80. That is a significant move. It tells you that input costs for manufacturers are rising fast. Those costs do not stay in the factory. They work their way to the shelf price, and the timing of that several months from now is worth tracking. Jobless claims dropped sharply last week to 189,000, the lowest reading since 1969. Some interpreted that as a sign of a very strong labor market. The more complete picture is a bit more nuanced. The rise of the gig economy means a growing number of people who lose traditional employment are not filing for unemployment. They are moving to rideshare, delivery, and contract work that pays more than the average $400 a week in unemployment benefits most states offer. But that does not show up in the claims data. The headline number tells part of the story. The full story takes a little more digging. Featured tools this week. We have several resources in the dashboard this week that are directly relevant to the conversations you are already having. The first is self-employed. Your 1099s qualify you for a home. Your tax return won't. If you work with self-employed clients, you know the challenge. Their tax return makes their income look smaller than it actually is. This resource walks through how that situation gets addressed. The second is switched from W-2 to 1099. You can buy a house today, not in 2 years. This one is for clients who made a career transition, assumed home ownership was now off the table. It is not, and knowing that can reopen a conversation that seemed closed. Third, your tax write-offs are killing your loan approval. Straightforward title, serious problem. Worth having in the toolkit for any self-employed referral. Fourth, waiting for rates to drop is costing you money every month. This is the resource for clients sitting on the sidelines who believe patience is the smart play. The math inside this one often changes the conversation. And fifth, the last 3 springs punished buyers who waited. This one rewards buyers who move. Spring market context delivered in a way that is easy to share. All of these are available on the right side of the dashboard if you're on a desktop, or below the video if you're on mobile. The featured calculator, the rate reduction calculator. This week we are featuring our rate reduction calculator from our financial calculator suite. Here's why this one matters right now. A lot of clients, they locked in over the past 18 months in the 6s and 7s, waiting for rates to drop significantly before they consider refinancing. But that is not always the right framework. The rate reduction calculator shows the actual monthly savings at different rate scenarios, the break-even point where those savings cover the cost of refinancing, and the long-term picture of what staying in a higher rate costs over time compared to acting at a specific target rate. It puts a real number on the decision, and that number often surprises people. This is a conversation tool as much as a math tool. When a client can see the break-even clearly, they stop waiting for a number they heard somewhere and start making decisions based on their actual situation. Strategy beats rate always. If you'd like access to our financial calculator suite, just ask and we'll send you a link. Looking ahead, next week's economic calendar, next week is jobs week, and it's a full one. Monday brings factory orders for March. Tuesday has new job openings in the JOLTS job openings report. The JOLTS number in particular has been closely watched as a measure of actual labor market demand. Wednesday brings ADP employment for April, and the market currently expecting around 79,000 job additions. That follows a 62,000 reading the prior month. Thursday includes jobless claims, non-farm productivity, and unit labor costs. The productivity and labor cost numbers will be worth watching, given the conversation around inflation and wages right now. And Friday is the main event. The Bureau of Labor Statistics jobs report. The current forecast is for approximately 73,000 job additions in April, with the employment rate holding at 4.3%. The prior month came in at 178,000. That is a significant step down in the forecast if the forecast holds, and the bond market will react. There are also multiple Fed Reserve speakers out throughout the week. With the current rate environment and the uncertainty around the Fed's leadership, any signals from Fed members about their thinking on future policy will be closely watched. A note on this week's resources. Everything we covered today, the featured tools, the rate reduction calculator, and the full presentation is available at rsrlinks.com/weekend update. If you're watching on a desktop, you'll find the tools on the right side of the dashboard. If you're on a mobile device, scroll below the video. Again, if you'd like the access to our financial calculator suite, just ask and we'll send you a link. We appreciate you listening, and we'll speak to you again next week. Have a great weekend.